Saurabh.
Excellent. So good afternoon, everybody, and welcome to a very special webinar for all of us at Marcellus. It is exactly 4 years since Marcellus was founded. So this was the day 4 years ago that the Ministry of Corporate Affairs wrote to us saying that we had been granted an incorporation. And that started a journey which has led us now to manage the best part of $2 billion of your assets. We're incredibly proud of the fact that you gave us the privilege of managing your money, and we thought that we should share with you what the journey has felt like. Right? There's probably too much to talk about. We can't give you a blow-by-blow account. Plus, COVID made it all the more dramatic. But we thought we'd share with you the highlights of the journey from zero to 13,000 crores of assets under management, a journey which has involved us managing money now for
we cannot hear you, Saurabh.
I think Saurabh has dropped. We will wait for a couple of minutes for Saurabh to join back.
Yes.
Sorry, I dropped off. So I'll request my colleagues to share with you the story of the last 4 years. So we'll begin with Sudhanshu Natha. Sudhanshu, if you could kick off your experience of creating Marcellus.
Yeah, sure, Saurabh. So it has been an incredible journey. Lots of learnings, lots of growth. When we started, I remember when we started Marcellus in August 2018, we had certain budgets, but the way the business has grown over the last 4 years, it has made us make multiple upward revisions to our internal targets. So many happy problems have come our way because of that. Just to cite an example, in August 2018, we started with the office of 4 people. In 18 odd months, by the time COVID kicked in, we already were 8x that size. And today we are 120 people working and managing all those monies. If we continue to grow, which we are very much confident of doing, we might have to ask our landlord to get a new premise because they can't accommodate our new requirements anymore. So it has been a fantastic journey, Sarah.
So if Sudhanshu's dealt with the real estate problem, Rakshit's dealt with the challenge of managing money on a large scale with what was very basic infrastructure. So Rakshit, over to you.
Yeah, thanks, Saurabh. Hi, and good evening. Yeah, it was a great start. I think problem was plenty from the beginning. Good problem to have, and infrastructure was a challenge initially. The best example of infrastructure challenge I remember is first couple of weeks after inception of CCP. We had just one room in the shared office space, and the table in that room had a pile of folders with signed account opening forms received from our clients by then. And we hadn't actually expected that we'll need a proper filing cabinet just yet, so we didn't have one. And then comes our head of trading, Anil, who joined us. And after he joined, we told him that, look, more than trading, we want you to first help us out with account opening, where we are severely short of bandwidth. Very kindly he agreed, and that's when the complications around laptop infrastructure started, I remember. So Anil, our supposedly head of trading, but who was by now helping us with account opening, he needed a laptop. Sudhanshu had ordered one laptop for him from Amazon, but Amazon delayed the delivery of that laptop by a few days. So Manish Hemnani, who was by then working with his office laptop, he offered his office laptop to Anil, and Manish himself started working on his personal Apple laptop. And then the next day, I was working in that room, and suddenly Manish says that I think he didn't tell us, but I think it was an expensive Apple laptop. The screen went blank, and Manish had a lot of stress on his face, and I didn't know what to do. We were short of 2 laptops in effect. Manish was running out of one. Anil didn't have his personal laptop gone. So I went back home. I took my car, went back home, and brought my full bada dabba desktop carrying it in my hand, and walked to the guard. Also asked, "Sir, what are you carrying?" I said, "Just don't worry. It's a device. I'll take it back home after a couple of days." And we had that desktop till the time Amazon delivered the laptop that was on its way. So that's the kind of infrastructural challenges with which we started. Good memory.
So those who are listening, please don't worry. We are now industrial strength technology. 4 years ago, clearly we weren't, but now we are industrial strength technology. So Microsoft Azure, Microsoft platforms, everybody has the high-powered laptops. But 4 years ago, it was a different story. So I think we will shift the spotlight to Manish Hemnani. 4 years ago, he moved from the UK to India to help us build the business. He's our, I think, Clint Eastwood, Tom Cruise, and Amitabh Bachchan rolled up into one. So Manish, over to you.
Yeah, thanks. Thanks, Saurabh. So yeah, hi everyone. So yeah, my name is Manish. I am responsible for the operations at Marcellus. So I joined Marcellus in October of 2018, which was just a few weeks back before we got our PMS license. And as Saurabh said, I had just moved back and I was just sort of settling in. And later on, I realized that was the calm before the storm. Right. So as we went live with CCP in December, everything became really fast. We were running out of everything pretty much every day. There was a day when our printer was printing 50s of forms every day, and the machine just got so hot it stopped working. On other days, we didn't have printing stationery. One particular incident I remember. So it's been 4 years now, but I remember as it was yesterday. We didn't have any staff here, right? So and we wanted you need a stamp paper to get the agreement in place. And it became a ritual where the first thing I would do is go out and stand outside the court to buy as much stamp paper as we can, so that we can prepare the forms and send out to our clients or our partners to sign up the clients. And we just couldn't get any. I think we would go and ask for 50 and we'll get 5, and then that's how we could sort of repeat the process. So me and Sudhanshu, I think we did it for a good couple of weeks before we found somebody who can actually help us procuring. And many times by that we stand in the line, by the time we get there, the shop used to shut. So we had to spend, again, wait for this. But I think that lasted for good some time. So it came really busy, really fast. But it's been a rewarding journey. Yeah, fantastic experience. So thank you all for your faith in us. But yeah, really enjoyed the ride.
So just for those of who are familiar with the template, we'll take questions as many as we can. So keep firing them into the Q&A box. Pramod will moderate that. But before he does that, Pramod will share his own experience of.
Great. Thanks, Saurabh, and thanks to everybody. Thanks to all our clients and partners who are on this call and who have supported us through the journey. It wouldn't have been possible without you. But having said that, while it looks like we've come a long way from our perspective, we've barely begun. I think 4 years in the world of investing is nothing. We intend to, or we aim to sustain this sort of performance for many years to come, because remember, we keep reiterating the term compounding. Real wealth is created when we do this over many years. But it's been a nice beginning nonetheless. My moment indeed was dramatic as a Bollywood movie. And that in some ways underpins the business case for Marcellus as well as the opportunity for many of you. It's about financialization of savings. I think it's, Saurabh in his previous avatar as an economist had written plenty about the beginning of financialization of savings, which later on the RBI in its historic report in 2017 showed that 95% of India's household wealth is in real estate and gold. That sort of underpinned the opportunity for Marcellus. Having put our life savings into setting up Marcellus, we were still nervous about the opportunity until we actually saw it really with our own eyes when we got to see real people's real portfolios. And there was this one incident that sort of drove the point home. This was in a small town in South India. This was November 2018, even before CCP had gone live. And thanks to an introduction from a friend of ours, I managed to get a meeting with a billionaire, perhaps running a textile export business from one of those textile towns in South India. And he was sort of reluctantly let me in. And when I explained to him what I had come for, he sort of dismissed me off immediately, partly for two reasons. One, he said that, look, I don't believe in financial assets. And secondly, I don't trust financial market people from Bombay. I guess it's for good reason. And then I asked him, looks like you run a pretty profitable business. Where do you put these savings? And then he proudly pointed out of his window showing all the land around the property, saying that pretty much whatever you see is all mine. So I pretty much plug in all my annual savings into land parcels every year. Now, obviously, I was disappointed, but nonetheless, had to leave the meeting. Exactly a year after this meeting, November 2019, I chanced upon the meeting with the same individual in the same town. And this time he right up front asked, how do I open an account with you guys? Then I asked him, what gave, right? What happened? And then he said that, look, over the last 12 months since our last meeting, there hasn't been a single transaction of a land parcel in this city. So for all it's worth, I don't know what it's worth. There's no price discovery. And then the illiquidity of real estate as an asset class sort of hit him home. And at the same time, I said, oh, these last 12 months, thanks for you to putting me on your distribution list. I've read enough in terms of newsletters and blogs and webinars that you've done for me to change my opinion about financial market people from Bombay. I trust you enough to open the account. And if the gentleman is listening to this webinar today, hopefully we continue to retain your trust. But that's the story of India, replayed many times over in those visits Saurabh, myself, Rakshit have done across small town India over the last 4 years. The opportunities hit home, but like they say, with the opportunity, there's also an immense amount of responsibility on our part to fulfill the trust that you've given upon us, and hopefully we'll fulfill the financial aspirations of all our clients.
Awesome story, Pramod. And in a way, Marcellus is the story of India, right? The lady on the screen and the men on the screen, we come from very humble middle-class families. Our parents are teachers, public sector workers, doctors, chartered accountants. None of our parents are landed gentry or Indian established elite. And all of these people, every single person whose picture you're staring at, have made real financial sacrifices. They've put crores of their wealth in this business, both in terms of assets under management and in terms of the critical seed capital, which fueled our growth until the business became self-sustaining. And in that regard, right, the fact that ordinary families like ours can take this sort of risks, I think there's a message there for the country. I think the country is moving in the right direction, and the evidence of the 11 people on this call, I think, is some proof of that. Let's move to Salil. Salil left a job at the largest family office in India to voluntarily shift cities and join Marcellus. Salil, your journey.
Right. So, when as investors or analysts, we generally tend to be very preachy about, what our investing companies should be doing, right? Sometimes even telling them how they should be running their businesses. In the early days at Marcellus, when we were all the small team, we were donning multiple hats, doing different roles. So somebody's doing something in HR, somebody's doing something on, space management, somebody is doing, digital marketing and so on. It is at that time, I realized that how difficult it is to actually run a business, the nuts and bolts of it. So it was a very humbling experience, right? It's one thing to ask your investing companies to run a business a certain way and then try and do it yourself. But at the same time, there was a moment of revelation where we, at least I thought that if we are not giving up, if we are relentless in our pursuit of building a successful business, in giving the best experience to our clients, then why should we hold our investing companies to a standard which is any different, right? So we learn from the best companies that we invest in, and hoping that they also, they also are true to the highest of the standards that we can set. Today we want to really assure you that we are going to be unrelenting in our pursuit of giving you the best investing experience that is out there. So it's been a great journey and great to be working with a team like this. And thank you all very much for being, putting your faith in Marcellus, being friends of Marcellus. Right, I think we should, Ashwin is next line, and Ashwin again is part of our investment team. You guys must be familiar with him. He's talked to all of you a number of times. Ashwin, your journey, please.
Yeah. So good evening, ladies and gentlemen. Nice to speak to you, something different than the usual portfolio related stuff. So when I joined Marcellus, my brief was about covering the auto ancillary sector and certain B2B companies. But the initial 6 and 12 months were completely different from this initial brief. So one is that I became a fund manager for the Nittin Times portfolio. The portfolio's launched a little bit ahead of the projected time. But obviously, we had covered some of the stocks in our earlier avatar, and the philosophy was ready. We didn't have to had to reinvent this CCP philosophy. Obviously, with some tweaking, I think the philosophy applied nicely to the small cap space also. So this was a relatively easier role. But the other thing which came away was managing the HR. So as Salil talked about multiple hatting, so I managed the HR and other related matters. This was a bit difficult for me personally. I'd never done this before, and also it was against my nature. So I had to completely get out of the comfort zone, interact with people across the firm. And also the COVID period was especially tough, a lot of uncertainties. But thanks to the collective wisdom of our leadership team, and thanks especially to the colleagues in the operations team, actually stepped out of their home and came to office and servicing all your clients. So it has been a very incredible journey. As Salil said, while we have learned and evolved over the last 4 years, but we have stuck to our core principles. From day one, we are clear about which stocks to invest in, which kind of people will employ in Marcellus. Very clear about being honest, transparent, communication to our clients and employees. So very interesting 4 years journey, and we are very confident there are many more milestones that we will achieve.
Thanks, Ashwin. Nitesh, if you could project the slides, my broadband connection isn't strong enough. So if you could project the slides, Nitesh. So folks, for those of you who know Nitesh, obviously you don't need any introduction. And I reckon at least 10,000 of our clients now know Nitesh, which is pretty much all of it. Those who don't know Nitesh, he's the other pairing of the twin duo of Pramod and Nitesh who run our sales business. And he's been sort of a real dynamo in us getting to wherever we have got to. So Nitesh, over to you, your journey of
Thank you. Thank you, Saurabh. Thank you, Saurabh, so much. Well, last 4 years has been simply amazing. To begin with, it was a life-changing yet thrilling decision, to quit a job and become part of a startup. And on top of that, moving away from my hardcore finance experience into sales, into sales role made it even more interesting. All the credit to the team, for showing faith and trust in me and believing that I can do sales. So we not only did sales, but we also supported operations. Towards the end of the day, when our phones used to stop ringing, we will pick up the forms and start filling it up, and helping our team to deal with the massive flow of forms. So last 4 years has been simply stellar, and we'll quickly take an opportunity to thank all our clients and partners who have shown trust and faith in Marcellus. Thank you so much.
So Tej Shah used to work at one of the leading venture capital firms in the country, right? So some of you might have heard that venture capital is all the rage in the last 4 years or so. So Tej was part of the most fashionable investing ecosystem in the country in a leading VC firm. He quit that to come and join forces with us. Tej, over to you.
Thank you, Saurabh. So if not for Marcellus, I would have gone on to maybe do an MBA. As things panned out, I applied for an investment role. I've been at Marcellus since. And what I can say at the least is last 4 years have been more than what any MBA in the world could have offered. Started out in the investments team in the financial services role. And like many people would have spoken about, I also did a bit of multiple roles. Within a year of joining, I was also looking at, out of all places, compliance as a function for some period of time. About 6 months into it, I also started looking or managing portfolios, bespoke portfolios for a few large clients. And then COVID happened. It's been a roller coaster over the past 4 years since then. And we hope that we continue to compound wealth just like we have over the past 4 years for many more years to come. And would like to thank all clients for reposing their faith in us.
Thank you. So our head of compliance, Parimal, he joined us 18 months ago from one of the largest investment banks in the country, where he was head of compliance. Now he's trekking in Ladakh this week, but from Ladakh, he sent a message. I'll play that. Tej, just let me know whether the message plays. Hopefully it will. So here we go. Let me play Parimal's message and let me know if you can hear it, Tej.
Sure.
Can you hear it, Tej?
Not yet.
Okay, so I think maybe the clip isn't playing. So in which case, let me read out Parimal's message, which he sent us from Ladakh. So Parimal says, and Parimal joined us 18 months ago. He's currently in the Markha River Valley in Ladakh. So those of you who are trekking fanatics will know where that is. He says his first assignment, he says, for my first assignment, we picked up the onboarding of large FII clients, foreign investor clients on the PMS side. That was the first time I actually saw how the team pulls together, how the team pulls its weight together and comes up with outstanding solutions, however tight the time frame. In little less than 2.5 months, says Parimal, in little less than 2.5 months, we were able to work on the whole systems and control piece for the relevant foreign investor to invest in India, to set up their account, to work with Indian and global custodians to come out with a novel investment strategy. The investment strategy has gone on to deliver, but more importantly, the novel investment solution has also delivered. We are excited to see our firm grow and help more clients achieve their financial goals. And as part of the compliance team, Parimal says, as part of the compliance team, my team and I are excited to be part of this journey and keep Marcellus on track to follow regulations not only in India, but also in different parts of the world. So we're also SEC regulated, and we're also regulated by GIFT in Gujarat. So Parimal and his team have their job cut out. But let's come on to the lady whose team has become central to Marcellus's future growth, and indeed has been central to Marcellus's growth in the last year or so. Sapna Bhavsar, she's our head of HR, and she joined also 18 months or so ago from one of the largest financial services companies in the country. Over to you, Sapna.
Thank you, Saurabh. I think Ashwin put it really well that he was double hatting. So technically, when I joined, I was the first certified HR professional. Joining at times when we were in the peak of COVID, hadn't met anybody in person, and that is a leap of faith which emerged from the connection that was when the world around us was thinking about right sizing. I think we went all out in our right hiring. So compounding also applies to our employee strength. We literally doubled in the last 16, 17 months. Well, it's not only a number game. I think for the first 8 months, our objective is very clear. We built some solid foundation for our people, practices, processes, policies, benchmark ourselves, at top of the chart for all the benefits, rewards that exist in the financial service industry. And I think the first foundation that we laid was how do we build our talent via the learning, development, culture building, and engagement initiatives. As we grow more, in all dimensions, that's what will take us through. And it's not just about work. I think we party even harder. A lot of milestones come together along with all our celebratory moments. So whether it is festivals, whether it is our anniversaries, whether it is just us and our families, I think that's where we've come together and share that sense of purpose. And we're looking forward to a lot more that's happening behind the scenes. So thank you, sir. And thank you, everyone.
Excellent. So those are our battle stories. Hopefully the years to come will bring more stories. There'll be fewer battles, hopefully, but let time weave its own magic. Let's move on. Nitesh, you can move to the subsequent slide and just put it on show mode as well. So Pramod, I'll request you to take over and just help people understand, right, how we have focused on a very, very simple goal over the last 4 years.
Sure. Thanks, Saurabh. I think it goes back to a time when we were on the sell side, and we had a client who's a client in Singapore who himself was a legendary investor, who sort of made a statement which we didn't understand for a while, but that has gone a long way in terms of us shaping the business that we have, the way that we have. He made a simple point. This industry is called asset management, but it's the biggest misnomer ever. It should be called liability management. When we asked him to elaborate on that, he said, look, investing is perhaps the easier bit many people pull off. But even if you have a great investment philosophy and have clients or investors come in with the wrong expectations, it's a self-defeating eventuality. And therefore, it's very, very important for you to get your clients with the right expectations. And more so because, like we mentioned, wealth creation is a simple aspect, but wealth creation requires patience and is achieved over long periods of compounding, which implicitly says wealth is created only if you stay invested. So whichever way you look at it, transparency is the bedrock of investing. More so because we are dealing with people's hard-earned savings here. And of course, that means that naturally people will give us the savings only if they trust us. And transparency goes a long way in terms of trust. So therefore, everything we do, we put out in the open. The sort of pictures you see on the screen are elements of stuff that we've used to drive home that transparency, whether through the newsletters by all our portfolio managers you see on the screen today. All of them are uploaded on our website and are available for public scrutiny. These are not simply sent to specific set of clients in the background. Similarly, the sort of webinars, the one that you're attending, all of them are recorded and uploaded on our website as well as on our YouTube channel. So everything that we've said in the past can be held for scrutiny and questioning. And now we've taken that to the next level. We've revamped our website. Hopefully many of you are enjoying the website. But the latest thing is we are launching our app for our clients. It's available for download on both Apple Store as well as the Google Play Store. We'll make wealth creation simple. So that's been the agenda, but we'll make it more accessible this time, accessible on your fingertips, on your phones as well. Somebody's already asked the question, what was the thinking? Like we said, we want to be putting our IP, our investment philosophy out in the open, completely transparently across all our domains. We don't believe that there is any rocket science in investing, as my colleagues have always said. It's a lot more behavioral, a lot more hard work and patience driven rather than any sort of scholastic skill driving alpha here. So reiterating our purpose here at Marcellus is to make wealth creation simple and accessible, and we'll continue to do our best on these two fronts. Back to you, Saurabh.
Fantastic. So let's move forward, right? You must have heard from us probably thousands of times in the last 3 years that we focus on a very simple style of investing: clean companies, well-managed capital allocation, and moated franchises. Nitish, let's move forward one slide. Right now, this simple philosophy of clean companies, well-managed companies in the sense of good capital allocation, as I think every bacha now knows in India, ROC of 15% or more over a decadal cycle or more, and then finally dominant franchises, pricing power of the franchises. It bears fruit. It actually bears fruit in real numbers, and we're trying to show you that in this table. So don't look at the left-hand side of the table. The 1 month numbers might look pretty, but it doesn't mean much. Honestly, it doesn't. The 3 month, 6 month, 1 year, 2 year numbers don't mean much. As we've shown in Coffee Can Investing, the low risk route to stupendous wealth, as we've shown in that book in 2018, in a less than 3 year time frame, you cannot, I cannot, nobody can judge an investment strategy. You need 3 years at least to judge an investment strategy. Ideally, you need 10 years, but you guys will say 10 years kiske paas hai. So you need at least 3 years, and we've shown that statistically. In fact, last week itself, on Friday, we published a newsletter, the Consistent Compounding newsletter, which again evidenced the fact that you need at least 3 years to prove a strategy's utility, its effectiveness. So consistent compounders now is the best part of $1 billion. You can see in the final column the absolute returns. I'm proud to say on 1st December 2018, I was client number 1. I was the first person to put money in. And I'm equally happy to say that when I got the newsletter this month on 3rd August, I saw that my money had doubled. So in 3 years and 8 months, Rakshit Ranjan and team, and 3 years and 8 months, Rakshit Ranjan and team doubled my hard-earned money. And remember, this is a large cap strategy. Typical market cap of a CCP stock is is 40 billion. So that's 3,20,000 crore, 3,20,000 crores typical market cap. We don't have any entry load. We don't have any exit load. Simple, high quality, focused, large cap investing, bearing fruit. You double your money in 3 years and 8 months, right? Then comes Little Champs. Little Champs actually completes 3 years this month, right? August 2019, we launched it. You can see the compounding in the last column. If you just apply the compounding, I was amongst the first investors in Little Champs as well. In 2 years and 8 months, Little Champs doubled money in 2 years and 8 months. And again, as those of you who have stayed invested with us in Little Champs, you know that we don't buy and sell anything like other small cap fund managers. We also run a very tight portfolio, 15 stocks. And as I'm sure you know, we don't raise money often. We rarely open Little Champs for inflows, right? Third product we launched was Kings of Capital. We launched this in July 2020. Again, I was amongst the earliest investors. Here we have seen earnings compounding being 20% plus. For better, for worse, the stock price compounding has been 12.6%, as you can see in the final column. Are we losing sleep about that? Is anybody running around Marcellus shouting at each other, saying, "Arey boss, compounding kyun nahi aa raha?" No, we're in fact trying to load up more on stocks which we believe have not grown as fast as the earnings would warrant. And again, the point of view remains very clear. Clean, more well-managed, moated franchises. None of this nonsense about low P multiple, low market ko time karo, isme ghusso, usme likh lo. Low churn, high quality, patient investing, you'll make money. And finally, the product which we launched exactly a year ago, a product in which the firm invested 10 crores. I also put my personal money in. This is Rising Giants. We're down 10% as of, I think a week back, we were down 10%. We're probably down 8 now, I think. But anyway, we are down. And again, is there anybody running around Marcellus saying, "Arey, underperformance aa raha hai, negative returns aa raha hai"? No, it isn't. Focused on these companies, and these companies are. Can you hear me, Pramod?
Yes, Saurabh, you're audible.
Yes, Saurabh, we can hear you.
Yeah. So we are focused on the companies. The Rising Giants companies are compounding earnings actually at 25%, and hence the focus is stay invested. Don't lose sleep about Russia, China, Federal Reserve, commodity prices. Invest in quality franchises and be patient. The money will come through. And I think that's our big learning, right? We've got 13,000 crores under investment. Out of that 13,000 crores, something like 9,000 crores we are outperforming. To our mind, that is it's just as important to work hard on that 9,000 as on the 4,000 crores where we are supposedly underperforming. The style of investing is identical across products. Clean, no chore promoters in the Marcellus portfolio. A lot of effort goes into avoiding chore promoters, right? Secondly, look for evidence that the promoter G knows how to allocate money. Most promoter Gs don't know how to allocate money. Thirdly, look for proof that there is dominance, there's comparative advantage, there's a moat, and combine all of that. Build a position, concentrated portfolios of 15 stocks, none of this nonsense of 30, 40, 50 stock, and run those portfolios with low churn. Stay patient, do hard work on research, make sensible decisions for your clients, and help them grow their wealth. So that's been our story. You've seen that play out over 4 years. Now, let's share some of the insights with you. If you look at our portfolios, right, let's move forward one slide, Nitish. If you look at our portfolios, folks, if we look at our portfolios closely, as Pramod has said, all the portfolios, all the research is on the website, right? So if you look at our portfolios closely, the portfolios are actually making money from 3 massive changes which are transforming the country right in front of your and my eyes. These changes are not some mystical subliminal changes. These changes have nothing to do with global macro or Russia or Federal Reserve. The first change is the gradual demise of big PSUs, right? And the big PSUs are a gift that doesn't stop giving. I think Tej and the Kings of Capital team wrote a lovely newsletter on 19 July on this. We have quoted from that. Please read the newsletter. It's on our website. What Tej and colleagues explained is what the PSU banks do is they allocate capital poorly. And the same is true in life insurance as well. They allocate capital poorly. As a result, they constantly need money. The government has to keep recapitalizing them, which acts as a constraint on growth. Because well-run private sector banks don't do that, they inherently have an advantage. An HDFC, a Kotak, a Bajaj Finance, a Chola have an inherent advantage, and we capitalize on that. The second area is where the PSUs are on hammering to nothing is talent, right? As all of you know, it's a tough market now for top quality talent. The PSUs have various compensation restrictions. They can't hire, they can't retain top quality talent. The best talent moves, and with it, the market share moves, right? So this is a theme which has played out in banking. We are confident it will play out in life insurance. We are confident it will play out in general insurance. And hence, as many of you know, HDFC Life, ICICI Lombard, Bajaj Finance, Chola, Kotak, HDFC Bank continue to be part of many Marcellus portfolios. Let's move forward, Nitish. Second insight is equally simple. Again, it's playing out in front of all of us. I think we've got the Purana version of the slides, Nitish. There's a new version, I think, without the yellow font. Anyway, whilst you get that, I'll just talk people through it. So what we have written about repeatedly is the change in the tax regime, both the GST changes and the September 2019 Nirmala Sitharaman corporate tax rate cut. Both were seminal events. And once Nitesh gets the chart back up, you'll see how 2017 and 2019 were inflection points in the demise of the informal economy, right? We've also got data which we'll beam up on how the government ramped up prosecution, right? Both court cases, conviction orders, criminal conviction orders, and court cases, how the government ramped these up over the last 5 years. And naturally, if you go after businesses which are avoiding tax through GST, you go after them through enforcement directorate, through CBI, through court cases, through convictions, you will end up with the informal economy getting squeezed, right? Now, you must have heard Rakshit say in CCP webinars how powerful a force this is for Asian Paints, right? Asian Paints by volume is half the market, but as the informal sector keeps dying, Asian Paints ka volume growth, as Rakshit would have told you repeatedly in the last couple of years, is closer to 30% now than to the 12% number which it used to be once upon a time, right? And this is the death of the informal sector. If you see the bottom part of that page, you'll see the same numbers for pipes. So as many of you know, Astral Poly is in several of our portfolios, and you can see in the pipe sector, however, the last 10 years, the informal sector has given away, and the organized sector, led by Astral and CPVC, is gaining share, and we are making money from that. The organized sector's share, that dot plot, the organized sector share, see how the structural shifts happen in market share, right? This is work done by somebody called the India Forum, and we've taken that very interesting work. And then the table on the top, this is data on how the government has ramped up prosecution, enforcement directorate action. There was actually even more data in this morning's newspapers on the subject. This will not stop, right? The Indian government needs to collect more taxes. Tax to GDP at 12% is an all-time high, but the government needs more money. China is not going to make India's life easy. We need to vastly step up defense expenditure. That means more taxes will be collected. The informal sector will be squeezed brutally. We will make money in Marcellus, right? And you can benefit from this. We've published a newsletter and a blog this morning about how you can benefit from the demise of the black economy over the next decade. The third insight is the steady decline of China over the last 6-7 years, right? Every year, the Chinese economy sinks further, and it's been quite a steady story, right? And we've written about it repeatedly, but the numbers suggest an utter disaster by way of capital allocation, right? So the beginnings of when we saw this was 2015. 2015 was the first time China's GDP growth started tonking off. And 2015, 2016 is the first time we saw Indian companies. You can see many of our investee companies' names in that table. 2015, 2016, our investee companies' market share started ticking up. And that's when we perked up. And as we perked up to what was happening in China, remember, it's a communist country, so they won't really let bad news get published in the Financial Times. But you can't hide an economic implosion when it's happening over an extended period of time. So year upon year, we get bad news from China. As I'm sure you would have heard over the last couple of years, the banking system's NPAs are now so bad, they express them as a percentage of GDP. Right? When a bank expresses NPAs as a percentage of balance sheet, it's sort of worrying enough. When a country expresses bank NPAs as a percentage of GDP, you know that there's a massive blow up, and you would have heard about companies like Evergrande and other developers who are defaulting on debts. Over the last 3-4 months, you've heard now of millions of Chinese households refusing to pay their mortgages. This is reminiscent of what happened in America in 2007. Households are saying, "Mera ghar to mil nahi raha. You haven't put the building up, boss. Mujhse EMI le rahe ho. Why should I pay?" Which means further blow-ups for the NBFCs, the banks, and the real estate developers. And then finally, the icing on the cake, as far as India is concerned, the Chinese premier's zero COVID strategy, where for whatever reason, they don't seem to want to use a well-accepted Western vaccines. Their own vaccine seems to have some issues. We don't quite know what the problem is, but they aren't able to get out of this COVID lockdowns, which keeps obviously smashing the economy. And you can see on the right-hand side table, the impact it has on market shares, right? So if you see a company like a GMM Pfaudler, 24% market share a decade back to 36% global market share, 36% revenue outside India. I'm sorry, GMM Pfaudler's global market share is 55%, but the revenues that GMM earns from outside India have jumped from 24 to 36. Perhaps a more like-to-like comparison is, say, Galaxy Surfactants, India's leader in surfactants. Again, part of our mid-cap portfolios. Again, big jump in revenues coming from outside India. Two-thirds of Galaxy's revenues come from outside India. This is a modest-sized company, $1.5 billion company based in Navi Mumbai. It's basically now an MNC, a mini MNC. And similarly, we've got many other companies on that list, Suprajit, which is also now a mini MNC. These are very interesting. These are knowledge-intensive companies. They're using Dimag. They're using Indian engineering talent. They're using hard work and process skills to pull away a market share from the Chinese. And I think this is the beginning of well-run Indian small and mid-cap companies who will go on over the next 10 years to build a mark as China's economy gradually implodes under the pressure of substandard capital allocation. Several of you keep asking us about market timing, right? I think probably if I had to ask Pramod and Nitish, what is our client's favorite question? I think the favorite question will be, "Ye right time hai kya?" Now, as we have said, we don't know when is right time, wrong time. And I also suggested to my colleagues, we should have a phone number ready. When a client says, so-and-so fund manager has said that this is the right time to enter, we should give the client that phone number, which should be a mental checkup line about people who go around pretending that they know how to time the market. We don't know how to time the market. We don't think anybody else does. But what we have seen is there are certain patterns which repeat themselves again and again in investing. And one of the simplest patterns which repeat themselves again and again in investing is America goes into recession in year T. In the subsequent couple of years, India's economy booms, right? Ever since India started opening up in the early 80s, this has happened 5 different times actually. So early 80s, America was in recession. 83, India's first boom started. There should be a chevron there. I'm sorry, it's missing. 83 ke upar, first chevron, the first economic boom in liberalized India. As I'm sure everybody knows, 1990-91 Gulf War. 93, India's second boom started. 2000 dot-com bust. 2001 9/11. 2003, India's third boom started. 2008, as Bachcha knows, Lehman Brothers. 2009, India's fourth boom started. And as I'm sure all of us remember, with the degree of trauma, March 2020, America in recession, COVID raging across the world. Ironically, a year later, India's fifth economic expansion since independence started. Now, as I'm sure all of you heard, in the last 2 quarters, America is in recession. The chances are pretty high that we get 2 to 3 years of solid GDP growth ahead of us. Why does this happen? The reasons are simple. The orange line is the price of crude. When America goes into recession, the price of crude starts tonking off. As I'm sure all of you know, in the last 3 months, crude is, I think, already down 25%. If America does continue sliding into recession, crude should continue cooling off because the world's largest economy going into recession is a surefire driver of crude cooling off. Russia is not a big oil producer, contrary to popular thought, and therefore the dominant feature will be the West going into recession, crude cooling off. And the second point is the cost of capital. Right? Typically, once America enters recession, the US 10-year bond yield falls around 250 bips. Now, will it happen this time? Will inflation Will inflation allow American policymakers to do that? We don't know. But our point of view is that if you wanted to ever understand what is the right time to invest, the best way to do is look for an American recession that typically presages a good 2, 3, 4 years from India. And just to put it in an extreme manner so that the point is crystal clear to everybody, India has never had an economic boom or a stock market boom without a US recession in the last 40 years. And in the last 40 years, America has never gone into recession without an Indian stock market and economic boom subsequently following. Right? Will history repeat itself this time? We don't know for sure, but we think the odds are pretty high. And let's move on. Final slide forward, Nitish. Folks, we keep writing. The next book hopefully will bring to you in spring next year. The books are intended as part of our broader effort to get the message out there on how to invest sensibly and make serious wealth in India by being patient, by investing in high quality companies. I'm sure you've seen these books before. If you haven't, if you want a copy and you want us to send you one, please let our sales team know. We'll be happy to oblige. So Pramod, over to you now for questions. And whatever questions let's do as many of them as we can, Pramod, in the time available.
Yeah, so Salil will be doing the Q&A. Over to you, Salil.
Yeah, so Pramod, right. So sort of the first question is, there are a couple of people who are asking that why was your picture missing on the first slide? And they would like to know about your own experiences or what you can share about the journey in the last 4 years.
Right. So honestly, whilst it's great, it's gratifying that people believe that I've had a big part to play in all of this. Honestly, I'm nothing other than the person who's in the happy circumstance of having worked with a great bunch of people over the last 18, 19 years. And it's my incredible fortune that those people who worked with me for 18, 19 years, Pramod and Rakshit, first started working with me back in 2004. Ashwin started working in 2009. Tej started working with me back in, I think, 2014 or 15. It's my incredible fortune that a super talented group of people have decided to come together and build this business. My job is simply to make sure that we do justice to this talent. We do justice to our clients' monies. We don't listen to the usual conventional nonsense about danadan fatafat paisa banao, follow this trend, that trend, follow PE multiples, do short-termist things just because people are shouting at you. My simple job is to create an environment where outstanding individuals, outstanding brains like those on this call flourish, build a happy career. And the result of that, I'm sure, will be tens of thousands of Indian families finally finding an investment manager who does justice to their savings. Indians save a lot of money. As I've said before, our household financial savings rate has actually doubled in the last 5 years. 7.5% से 15% हो गया. Household financial savings rate 15%. Overall savings rate now pushing 25-26%. So Indians save a lot of money. But as we've explained in coffee can investing and in diamonds in the dust, the problem historically has been kind of the misinvesting of that money in flats in Gurgaon or Noida or Lower Parel or Vashi or wherever, bars of gold, high-risk corporate bonds, junk bonds basically, and then this whole satta market around buy small caps and time their entry exit. My simple role is to create space for this team to do the right thing for the 10,000 clients for whom we manage money. I'm very grateful that I have a chance to do that. I feel genuinely honored that I had a chance to do that. And what can I say? It's transformed my life that I can do something that I believe in with a group of people in whom I believe in, for a country that I have full faith in.
Great, Saurabh. Thanks. The next question, I'll keep this open to anybody in the team who wants to answer, is that, who came up with this counterintuitive idea of making all our research, all our writing open source or open access? Was there any pushback within the team that, why do you want to disclose everything that we do and how we do it?
That's a tough question. Who came up with the idea? Pramod, do you remember who came up with the idea?
No, I don't think anybody needs to. Like most of what we do, all of us were in consensus, which is why I guess we've come together as a team. I don't think there was any resistance from anyone to put out their research created with a lot of hard work into the open. I can understand the basis for the question. Yes, if you put in all your blood and sweat into creating an IP, you would want to sort of monetize it. However, I don't think there was any single resistance from anybody in the team, because we'd all come together to build a fairly transparent organization, not just to our clients, but at the public at large. Because like mentioned in the past, we want to subject ourselves to public scrutiny. We would want to hold our IP and research to that standard that even when it put it out to public scrutiny, it comes out unscathed. So yeah, I mean, great question, but I don't think there was any resistance at all.
So if I could just highlight an anecdote here, which both explains how the team works, the business functions, and also explains why my role is actually quite modest. So like, I also read these management books here, what else to do on weekday evenings. So these management books say, you should do a strategy session. The team should align around the same strategy. So I remember doing one of these a year or so back. I told the team, think about it. Hamara strategy kya hoga agla 10 years? What is our big strategy? Kya competitive advantage hai? And, everybody thought about it for a week, and then we convened in the office. So I said, so what's the strategy going forward? What's our big competitive advantage? And basically, almost everybody said, and they said this, I don't think that they had consulted each other. They said, our strategy will be the truth. So I said, what do you mean? What truth? Is it some religious text you're referring to? They said, no, not the truth. We mean by the truth, we will do the right thing. We will do the right thing for our clients. We will do the right thing for our staff. We will do the right thing by the country. And that will be our strategy. Right. So honestly, I was a little stunned for a few minutes. I remember I sort of stuttered through the next 10 minutes saying, what sort of strategy is this? The right thing, the truth. But over the next, a couple of hours of discussing it with my colleagues, it struck me why this is so counterintuitive. And I think the person who's asking the question is getting to the heart of it. If you play the infinite game, you build a business for the long run, a business which lasts generations, a business which is not just about mera bonus kya hoga, Pramod ka bonus kya hoga, a business which is about saying, can we do the right thing for millions of hardworking people? We will make money in the process, but that's ancillary. If we do the right thing, right, be transparent, crush costs, work in humble offices, take home modest salaries, create a business which creates a massive surplus for clients, everything else will fall into place. That is easy to say. It's bloody hard to do because it involves hard work. It involves a degree of sacrifice, and it involves a degree of transparency, which I think most people will find comforting. But if you can do it, as we have tried to do, and we hope to be able to continue to do, if you can do it, it's an insane competitive advantage.
Sure. Pramod, while you are still around, if you can, between you and Nitesh, you can answer this question is, how did you come up with this fee structure, which probably was one of the first and one of the most unique fee structures in the PMS industry?
Well, I think we've been on the other side in terms of subscribers of funds and stuff. And what we've always believed in, right from, Saurabh talked about us getting together in 2004. This was a firm called Clear Capital, perhaps one of the world's first independent equity research firms in the true sense of the word independent, because as sell-side equity research is beset with inherent conflicts of interest, that's what attracted us to building an independent equity research firm back then. So an element of breaking conflicts of interest is part of the DNA. And that's when we thought, when we decided to think of a fee structure, how can we align ourselves completely to our clients and investors' interest? By having a zero management fee and having pay for performance model, we subjected ourselves to that total alignment of interest with our clients. We said, we don't want to make any money if our clients don't make money. We will make money only if our clients make money. And that resonated with everybody. And like I said, it's always great to work with a bunch of people who have the same ideas. And I'm glad it's been taken up by investors.
Thanks, Pramod. Now, here's an interesting question: is that there's a lot of investing is also about risk management. And somebody's quoted Charlie Munger saying that you need to avoid stupidity first, right, before making money. And people say that they haven't heard much about risk management on our webinars. So I think I'll pass this on to Rakshit. Rakshit, if you can tell us, do we do any risk management at all, and how do we do it?
Sure, Salil. Thanks for that question. It's a very important question for any fund manager to think about. So when we do our fund management, actually it starts with risk management before we even worry about returns. And the only tools that we have in this philosophy are around containing risks. So there are, broadly speaking, two types of risks that we manage under our philosophies. The first one is a binary risk, where if it's an accounting issue, if it's a governance issue, then it's a switch on or switch off. Absolutely clean accounts. We are open to understand the fundamentals. Red flags around accounts. We just don't want to play that risk. There is no reward that can convince us. There is no expected reward that can convince us that it's worth playing the risk of accounts, risk of governance in our portfolio. So that's a binary risk, and we might end up missing out on the best compounder for a certain time period. But if that best compounder stock had this risk in it, then we'll always stay away. So that's the first type of risk. The second type of risk is something that cannot be sort of completely mitigated, but we use a few tools to reduce it as much as possible, which is the risk of making weak returns, risk of volatility, uncertainty around returns, emanating from either uncertainty in the fundamentals of the business or uncertainty in the sentiment of the stock market, causing volatility, noise, so on and so forth. And we've typically come across two very strong tools, two very powerful tools around which we've weaved our philosophy of investing. One is time period of investing, where provided you have, let's say, 3 years or longer time period, you mitigate all non-fundamental factors oriented risks in your investment approach. And these non-fundamental factors oriented risks could be things such as, in the last 12 months, concerns around FII outflows. Now, it's a massive risk. We don't know if in 2023 or 2024 we'll be faced with FII outflows. We don't know if the market sentiment will cause a massive crash in the short term, so on and so forth. So those are the risks. They are non-fundamental as long as they don't affect the fundamentals of our portfolio companies, but our short-term returns can get adversely affected by them. And the biggest tool to mitigate that is patience. To quantify, the moment you move from, let's say, 1 year time horizon to 3 year time horizon, there's a significant amount of reduction in the risk of non-fundamental factors playing around with your portfolio performance. And associated with that, another tool is which mitigates the fundamental risk. Fundamentals risk is of picking up companies where competition can unexpectedly cause turbulence in the reported fundamentals subsequently, or picking up companies where the rate of compounding, even if everything goes well, is not healthy enough for the fundamentals rate of compounding to help you compound your wealth. And hence you need extra timing related benefits, buy low, sell high, buy low, sell high. And that risk around fundamentals being weak or uncertain gets mitigated by focusing on immensely strong businesses by means of competitive advantages and their capital allocation discipline. If you pick up companies which have the ability to compound, if you actually get convinced about companies which have the ability to compound their free cash flows north of 20% in a very steady manner over the long term, you mitigate many fundamental risks. So I would actually say risk mitigation is all we do. Returns being healthy and consistent is just an outcome. We don't chase that at the outset.
Great, Rakshit. Thank you. Now, here's an interesting question.
There's a question that's come via email. So
okay.
That to you, actually, you're the best person to answer this. So the questions come from Ravi Shankar ji. So he's saying that, look, the Marcellus approach is totally different from others' approach. So he says other PMSs, they say ye trend chal raha hai, EV trend, renewable energy trend, defense stocks ka trend, right? That sort of thing. Whereas our approach obviously doesn't have any of this trend nonsense. So Ravi Shankar ji asked 2 questions, Salil, and he's repeatedly sort of fervently requested your thoughts on this. So he says, is it more rewarding to identify growing themes like EV and renewable energy? Is it more rewarding to identify a growing theme, enter a few stocks early, and ride the growth and capture a lot of value of the steep growth? Or should we just ignore trends and do the Marcellus thing, which is clean, well-run, moated franchises? And the second question he asks, he said, does the Marcellus approach identify has-beens? I think the Hindi translation is, does the Marcellus approach identify thaka hua stocks that have already ridden their growth and captured a lot of value, and therefore the Marcellus approach loses out on emerging stars, right? What do you think, Salil? What's our thinking on these 2 subjects?
Yeah. Okay. Again, interesting questions. On the first part, you see themes and all. It sounds actually nice, exciting. To identify what's going to be the sectors or industries of the future. But what we strongly believe in, and I think that's what we also advocate, is that finally business has to make money. It has to make a lot of money, more or rather much more than what its cost of capital is. As long as you identify this aspect of a business, it doesn't matter what sector, what theme, what industry, future, backward, nothing else matters, right? And doing this is a lot of bottom-up work. It does not really work top-down, right? Renewable, I think, Saurabh, you mentioned renewable energy as a sector, which, as we mentioned, I would not say I'm an expert on this, but I really doubt if there is any renewable energy listed company in India which makes a return on capital which is significantly higher than its cost of capital. It's exciting, it's new, it's the future. So you'll see a lot of revenue growth, but not necessarily accompanied with enough profitability or profits. So yes, our philosophy is to not look at such bottom-up, top-down themes, but to focus on 3 fundamentals, right? Clean accounts, competitive advantages, and very, very sound, smart capital allocation. And the second, sorry, Saurabh, can you just repeat the second question, second part of the question?
So Ravi Shankar ji's worry is that, Marcellus invests in thaka hua stocks, whereas, these other fund managers, because they're ahead of the curve, dynamically theme pe jump kar raha hai. He's getting it before. Whereas we too are just doing thaka hua stocks. How do we deal with that point of view?
Right. In fact, this question comes up every day, and I'm assuming that if we would have been around for 15 years, then this question would have come every day for the last 15 years. Is Nestle, for example, or Asian Paints were thaka hua stocks, because these were fairly mature, well-established businesses even a decade ago. But what has happened in that decade is the rate at which business cash flows have compounded has not shown any sign of thakahness or whatever you can call it. And this is because these businesses are fundamentally very, very strong, right? The competitive advantages that they have and what they're doing to sustain those advantages is something which is what is more important to look at. And as long as these guys, we would use the word relentless, as long as these companies are relentless in holding on to their competitive advantages, they'll never become has-beens, right? They will always be compounding cash flows at 20% plus, and that is what will eventually reflect in stock prices. What will happen to, again, going back to themes, is that once the theme dies down, because renewable energy, EV, for example, there's something else which will come tomorrow. You don't really know what happens to this whole bunch of stocks which were riding this theme or wave. So again, the same message: focus on bottom-up investing, figure out companies which will have those 3 attributes that we always speak about. I hope that answers the question, sir.
Perhaps we should do a webinar one day, Salil, on the great themes that didn't work, which is pretty much every theme in the last year. A good fun webinar to do. Over to you, Salil.
Right. Okay. There are several messages, wishing us on the anniversary, and a lot of congratulatory messages. So thank you, all of us. We'll try and reply to you individually, but please bear with us in case we will miss out. Okay. The next question, again, a couple of people have asked. So one is, we talk a lot about succession planning. So the question is that if somebody is investing with us for the long term, as we prescribe them to do so, how have we thought of succession, right? Or is it too early? So do you think that somebody is investing with us for 10 years will have the same investment experience in case some of us on this call are not around in the 11th year?
So I think we're doing everything to ensure that they will have the same experience 10 years out, 20 years out. What are the steps we are putting in place? I'll request Rakshit first to comment on that, and Sapna, if you could comment on how we are investing in people to make sure that this is not a 1-man, 3-man, 5-man, woman show. So Rakshit, first off, if you can take this.
Sure. So there are a few frameworks which are already put into action at Marcellus. The first one is decentralizing decision making, even during these 10-year periods, during this first 10-year period, right? Before we come to continuity, succession planning actually is a lot more about scalability. We are managing monies of several clients. We are managing monies across several stocks. We are managing monies across 4 different philosophies. And hence, we cannot afford centralization of decision making, because one, that will lead to bandwidth getting maxed out and quality getting compromised. And secondly, that will also lead to sort of biases kicking in. And as fund managers, we are very conscious of the fact that over a period of time, we'll have to keep evolving. We'll have to keep sharpening our tools, so that with the changing external environment and the changing fundamentals of the companies that we attempt to invest in, we keep changing and evolving our philosophy, our approach. So that decentralization part is actually the first thing before we come to continuity, and that is heavily underway. If somebody is interested, please ask us a question we can separately answer about how rigorous, in a decentralized way, a discussion on a particular stock happens at Marcellus every Friday, when the whole research team comes up with the investment committee to discuss and debate ideas that had been shared, circulated around emails. Everybody comes having well read what the analyst's view is, so that the debate can be deep enough and can lead to a very successful outcome. So that sort of a process is already underway. And then comes continuity piece. Now, when it comes to continuity, if you put processes in place, if you put systems in place, then the decision making can move on from one individual to another, right? So for instance, just to give you an example, when Marcellus started, I was not just the fund manager of CCP, I was also the consumer analyst for many of the stocks that Marcellus's CCP bought into. Today, I don't spend even a single hour doing research on consumer stocks, and it's been a very long time, a couple of years since a couple of my colleagues have taken over coverage of consumer. That's just a very small example about my sort of transition of responsibilities, and in a similar way, the evolution is already underway now. What we are very, very conscious of is we do not want to kick off succession without having trained the successor, without having sort of put in place. So Sapna will probably talk about many of the tools she has given us, and one of the tools she gave us was IDP, full form individual development plan, stuff like that, right? So we've got those plans going, so that the future potential successor is mentored into that role, groomed into that role before the transition really kicks off, which is very, very important because we cannot afford turbulence because of succession. So those are smaller examples that I've cited, and even when it comes to leadership decision making, the discussions started off more than a couple of years ago, and frameworks have been put in place about how and when we will provide the continuity and scalability to leadership decision making into the next 3, 5, 7, and hence 10 plus years of Marcellus's evolution. Sapna, over to you. You're an expert.
Thanks, Rakshit.
Yeah, we can hear you now without the echo.
Okay, sorry about that. So yes, while the policies, processes, all of these are in place, people play a big part. By the virtue of this being just a 4-year-old organization, startup, people joining us at various stages, they have naturally double-hatted, triple-hatted, and a lot of things, which means there is a whole rounded experience that automatically came in. And that's the flavor that we will not want to lose even going forward. It's equally important that people see the ups, the downs in the market, while at work, in life as well, so that when they take on much larger critical roles, they know how to deal with all these criticalities. So the framework that we spoke about, the individual development plan, will be more customized to each individual to see what really needs to go back in building that potential and preparing them for various roles, whether it is internal leadership roles, fund manager roles, and so on and so forth. And that's an emphasis that will continue to play. So a lot of work will have to be done while we work, while we speak, but equally more so in terms of learning and development. I think that's what you did mention when we said that we've already begun that journey. So yeah, those are 2 bits from my end.
Back to you, Salil.
Thanks, Sapna. Okay, here's an interesting question. I think after listening to our journeys, right, some people think that we all probably are all thinking alike. So the question is that, is there somebody who plays the devil's advocate in the team? And kind of just to make sure that we are all not victims of groupthink.
So I think, Salil, you're the person best placed to comment on that. So amongst us folks, Salil joined us, as we mentioned, right, 3.5 years ago. We knew Salil from his erstwhile avatar, but we hadn't worked with him in his erstwhile avatar. Sapna joined us 1.5 years ago. And again, both of them bring very useful perspectives. Both of them are unhesitating in questioning other people's opinions, whether they be other founders, other people who have worked with the founders over the last 10, 20 years. And we are richer for that. So for example, when we built the business, the compensation policy, how we pay salaries, how we pay bonuses, how we distribute ESOPs, Salil and Tej designed the compensation policy. Pramod, Rakshit and I had actually no say in it. Similarly, this year's appraisal round, this year's bonus payouts, Tej, Salil and Sapna spearheaded that. The other founders had very little say in it, including myself. And we've tried as much as possible to create that construct right through the team. So on an ongoing basis, all analysts are encouraged, indeed incentivized. They're actually given positive points in their appraisal for challenging currently accepted views in the research team. So if we have, if Asian Paints is a large position, or HDFC Bank is a large position, or GMM Fodler is a large position, all 22 analysts have an incentive to challenge that point of view and bring about a change in our thinking. That's actively encouraged, incentivized, and rewarded. We recognize that we need to do more in this regard, right? We need to do more in this regard of building a firm where challenge to the received notions, challenge to conventionally accepted notions in Marcellus should be done more aggressively, more proactively, and we're working on that. I think this is an area we can improve in considerably in the years ahead.
Thanks, Saurabh. Nitish, this one is for you. There seems to be some confusion on whether NRIs or what kind of NRIs can invest in India, depending on geography. And one gentleman is a little worried that when he goes to our website, he sees a very serious warning message asking him to select where he is based. And kind of that puts him off from going ahead and browsing the contents of website. So if you can just explain these two aspects.
Sure. So second question first. So now we are SEC regulated, and hence, there are a lot of restrictions that has been placed by SEC that we have to adhere to. And whenever you visit website, that's why, a pop-up comes asking whether you are from America or others. So that's the only reason why, you see that pop-up, because for an American who is logging in, there is a different content, lot of content we cannot show to them because of SEC guidelines. Now, to answer your first question, almost all NRIs can invest now, apart from Canada. So now, because we are SEC regulated, we can also take money from American NRIs, even if they're not in India. But apart from that, there are no restrictions. Only Canada citizens have to be in India if they want to open an account. Any other NRIs, if wherever they are, we can complete the paperwork and we can take your money.
Thanks, Nitesh. Okay, here's a question. I think one of the fund managers, if they can just pick it up, is actually there are a couple of them. Is on you showed us a slide. Absolute performance has been fine, but relative the performance is there in some of the strategies that you run. What do we think about this, and what do we have to say about this? Raksha, do you want to take it?
Yeah. So look, to begin with, all these concerns that have been there so far about absolute returns or relative returns on our funds are concerns related to a time period less than, say, 18 to 24 months. Over the last 10 months, 12 months, 14 months, these questions are valid, but over time periods as long as it's 3 years, 4 years, these questions are not valid, because we've had a very healthy outperformance and a very healthy absolute return. Now, why are we not too worried about the last 10, 12, 14 months? It's only because over this relatively shorter time period, the fundamentals of our portfolio companies have continued to compound at the rate at which we would expect them to compound. In fact, on the contrary, our portfolio companies have massively benefited from the developments of COVID as an event, and Russia-Ukraine war and all the volatility that subsequently, let's say, things like our portfolio companies have massively benefited from this, and in that regard, we are actually very, very comfortable with how the fundamentals have developed. Now, in this context, if our portfolio companies' share prices, they don't compound at a very healthy rate, then that's not a worry, because eventually over the longer term, fundamentals dictate share price trajectories. Share prices don't tell a story about the fundamentals independently, right? So that's a very, very important message everybody needs to take back home when they look at short-term share price performances. Fundamentals always dictate share price trajectories in the long run, and in the short run, share prices can and they will deviate from fundamentals, and if they do so, investors don't have to be worried, and that's the main reason why we are not too worried.
Right, Rakshit. Okay, here's again an interesting question from this is from Narendra Khadse, and he's talking about skin in the game. Saurabh, I think you mentioned in the beginning about how we have invested in Marcellus. I think what some people are here believe is it's just you. So if you can just tell us about whether it's in our schemes or in Marcellus equity, what is the skin in the game that the people here on the call have?
Sure. So the firm is owned 90% by its employees. So across 35 employees who we own 90% of the firm. There is one shareholder, two families in Bangalore, highly reputed families in Bangalore who own 10% of the firm. They've been very helpful in guiding us at critical stages of our development, as much for their guidance on what buttons to press at what stage of our development, as much for the money. We brought them on board very early in our development. So 90% is owned by the staff. 35, I would say close to now 40. The ESOP round is coming up in September. I think after this ESOP round, 40 of our 60 most senior people will become equity participants in the firm. Every single person on this call, as I said, owns equity. Every single person on this call is heavily invested in Marcellus's products. In my case, all of my equity assets in India are in Marcellus's funds. I think that's the same is true for most of my colleagues on this call. All our junior colleagues who cannot afford the 50 lakhs ka PMS, their equity holdings have to mimic Marcellus's portfolios. That's a rule that compliance enforces every quarter. All our junior colleagues, I stress, cannot hold stocks other than Marcellus investee company stocks. If they don't have 50 lakhs, they can hold it in their personal name, but compliance checks that and they have to sign that they haven't invested in a single company which is not part of a Marcellus portfolio. Thirdly, the entire leadership, whatever bonus we get, only 1/3 we get in cash. 2/3 of our bonus gets invested in the Marcellus funds, right? So our funds, our portfolios contain 2/3 of our bonuses, and those bonuses are held back and given out on a staggered basis. Interestingly, whilst this rule exists that you can only take 1/3 of your bonus, 2/3 you've got to invest in Marcellus's funds, Marcellus's products, what I've seen is whatever cash bonuses colleagues take, they are either reinvested back in our portfolios or they buy Marcellus stock. So Marcellus stock is actively sought after by the leadership members. From time to time, somebody needs to buy a house or somebody needs to pay for their children's school fees or some other emergency. We buy from each other. So if I look at the last 4 years, I don't think any material portion of the leadership savings have gone into anything other than investing in Marcellus's stock, the company's balance sheet, and B, investing in Marcellus's funds. I can't think of, I haven't worked in any other firm where this sort of equity commitment has been made by whether I like it or not, we are middle-aged people with growing kids. I can't think of any other firm where this sort of equity commitment has been made by relatively senior people at advanced stages of their careers. And I'm very grateful for it. Just to take an example, I didn't ask Salil or Salil's better half to invest in Marcellus's products. They aggressively do so, consistently do so. And all I can try is to make sure Marcellus gives Salil and his better half as good a return as it gives to its other clients. Back to you, Salil.
Thanks, Saurabh. So here, just to kind of add one more thing is that one of the big challenges that we have in recruiting talent is that we do tell them upfront that once you join us, you can't invest directly in equities. You'll have to route it through only our portfolios, right? And that's sometimes a big point of discussion between prospective joiners and us, right? So Saurabh, here again, this one is for you. This is an interesting question. You mentioned that the young analysts in our team need to mimic Marcellus's portfolio. But to the young people out there, is there anything that you can tell them about how should they be thinking of managing their finances till the time they are, they have enough to really become clients of Marcellus?
So look, I think the first thing to do is if you want to invest your own money yourself rather than say getting an RIA. RIAs are easily available. They don't cost a lot of money. My friend Anupam Gupta, co-author with me on the Victory Project, he's published a lovely book called The Wisest Owl, which highlights for you 6 of India's best RIAs, right? Their email addresses, their contact details are given. So Anupam's book, The Wisest Owl, highlights, and Anupam's done solid research on identifying India's 6 best investment advisors. Read the book. If you don't want to read the book, at least get the names of India's best RIAs. So whoever you are, wherever you are, if you don't have the time to read books like Coffee Can Investing or Diamonds in the Dust, hire a good RIA
and they will give you a very good advice on what sort of products to buy when you are starting out your career, when you're in your 20s or early 30s, right? Which term life product to buy, how to create a rainy day corpus, where if God forbid anything happens to your employment or to your health, you're in a good shape to look after yourself and your family. And then if you are able to invest in your equity investment education through good books, through courses on accounting, courses on analyzing annual reports, then start building the portfolio. Our portfolios, as Pramod highlighted, are freely available on the website. The names of the stocks are available. The research behind the stocks are available. Detailed webinars from people like Salil, Ashwin, Tej, Rakshit are available free of charge. Use that to guide your thinking, shape your thinking on how money should be made, and stay away from this nonsense that you keep getting, right? This social media ka and this day-to-day conventional media ka nonsense about ye khabar aayi hai, wo khabar chal rahi hai, ye trend chal raha hai, this is the hot sector, that is the hot theme, all of this stuff, right? Blockchain, crypto, EV, fintech, shintech, right? This is the kind of noise. And when you find yourselves able to block out the noise, when you find yourselves able to block out this day-to-day noise and able to read annual reports with a calm frame of mind, that's when you know you're in a position to make your own investment decisions without either needing to read our research or indeed needing to heed a third-party advisor. But don't rush into it. There is no sort of clock that's running out on you. Koi bus nahi nikli ja rahi. This country will continue growing at a healthy pace. Good companies will continue compounding at a healthy pace for a long time. Invest in your education, invest in your development. If you can't do that, get a good RIA. Anupam Gupta's book, Devised Style, available on Amazon, gives you the names of 6 of India's best RIAs, and their contact details are also given in the book.
Thanks, Saurabh. There are tons of questions, but unfortunately, we are just about running short of time. So we'll take one last one, which is, we have got 5 different strategies. For a first-time investor, this question comes from Pankaj Sawa. For the first-time investor, how should he think about investing with us, or how should she think about investing with us?
So as you could see from that performance track record we published, right? CCP has the longest track record. It's going to hit its 4th anniversary in December this year. We've been running it for ourselves for the best part of 6 years now, through many different exigencies, many different crises. We have seen CCP hold up returns in the 20-21% mark post-tax. It's the most liquid of our portfolios, the largest set of dominant franchises, and it consistently guns out good returns. I think Rakshit did a great webinar, I think a year or so back, on how tight the standard deviation, how tight the normal distribution curve of CCP. So if you want a dal chawal for your, dal chawal being the kind of core of your meal, right? The core of your carbohydrate intake and your protein intake, then use CCP to build the basic platform of compounding. Once you've done that, once you've invested, I would say at least 60% of your wealth in CCP, then think about, if you then have surplus corpus, then think about rising giants, kings of capital. And then if we open little champs very rarely, at the moment we're not taking inflows in little champs. If you get to a stage where you've also done rising giants and kings of capital, then little champs is your rabdi malai. You should have it in moderation. If you have money and you want to put it in a portfolio which has historically given you 30% compounding, but is more volatile than CCP, then keep your money dry, keep your powder dry. Register your name with the sales team so that when they take inflows into little champs, they put in a call to you.
Right, Saurabh. I think that's about it. We are just about done. So thank you very much, everybody, for being on the call. Thank you very much for your support. And we look forward to servicing you as we have in the past. Saurabh, any closing comments from you?
I think it's been a tremendous journey. We wouldn't have been anywhere without the people who have backed us over the last 4 years. Clients, wealth managers, supporters, well-wishers, people who make this country special. We thank you with folded hands, and we look forward to your support for many years to come. Thank you very much.
Thank you.
Thanks, everyone. Thank you.